Hi, good afternoon, everyone. Thank you all so much for joining us today for our webinar, CIO's Corner Quarterly Update with our Chief Investment Officer, Chris Gauthier. For those of you who are joining us for the first time, my name is Amanda Sylvia, and I am the Client Service Associate for Stonehearth Capital Management. I would like to start off with just a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring all of your questions and will ask Chris to answer as many as he can at the end of the webinar. If we do happen to run low on time and are unable to get to your question, Chris or myself will reach out to you directly after the webinar to make sure we do get your question answered. Now I would like to introduce our speaker for today. Chris Gauthier is Stonehearth's Chief Investment Officer. He brings more than 15 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting our firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda. Thank you for that wonderful introduction. And I would like to thank everyone for joining me on this beautiful fall day. Quite a change from yesterday, and it's going to be quite a change from what's happening tomorrow if you live here in New England. So buckle up again, could be a bumpy ride for the weather anyways. As always, we're going to go over a few things consistently we're going to talk about asset class performance, performance numbers for the last quarter and year-over-year returns in terms of asset classes and factors. Take a look at the current investment environment. It's really pointing to, higher interest rates ahead, higher inflation, and more persistent than the Fed thinks is going on in the market, and really above trend economic growth against a really backdrop of extended valuations. We'll take a look at our internal risk model, see what that's telling us about the environment. And then finally, we'll wrap it up by looking at portfolio positioning, how our portfolios are positioned to manage risk. And as always, take advantage of opportunities we're seeing in the marketplace. Because as we like to say over here around Stonehearth, where you take risk is more important than the amount of risk you take. So with that, I always like to start with our investment philosophy. I think it gets a nice framework for our discussion. It's how we view the markets and really sheds light on our thought process and leads to a better understanding of the conclusions we come to. So the first thing, mean reversion, right? Trees don't grow to the sky. We do see asset prices and economic data revolve around a long-term average. Price matters, right? What you pay for something drives returns. This is that valuation. Factors, we believe in core factors, quality, momentum, value, excess yield really gives you excess returns above what can be found in a market cap benchmark. Diversification, still the only free lunch in investment. And finally, risk is not stationary, but must be accounted for in portfolios at all times and fluctuates throughout the market cycle. So with that, let's turn to performance. What we're looking at here is the S&P 500 index going back to 1996. Again, up and to the right, what you'd like to see. But like here, what it's doing is comparing current conditions to where we've been at previous cycle highs. So if you look at that call out box, you see March 24, 2000, for those who were alive back then. That was the dot-com bubble. You look at 10/9/2007, when most of us were alive for this one. This is a great financial crisis. Then it's kind of looking at February 19th, which is the start of COVID, and where we are right now. So you can see when you compare to history, the current peak to previous peaks, most things are the same. The PE ratio is very similar. The dividend yield is very similar throughout history. The big difference we come to is that 10-year treasury yield. So that's that Fed intervention there. And you can see how low it is compared to history. So there is a difference. History often rhymes, but it doesn't repeat. So it's similar, but there are some different characteristics in terms of this peak compared to previous peaks. And if you look at this chart, that dot at the end right here, you can see this little fall off. That's that small 4.5% rise we saw, fall back we saw in September compared to this huge rise we've seen off the bottom from COVID. It really did nothing to alleviate the overvaluation picture. You can see that from the PE ratio at 20 times. We'll take a little closer look at valuations further along in the presentation. But the step back and the long-term technical picture still remains positive, right? It's headed in the right direction, and we didn't break any long-term macro trends with that small pullback we saw in September. So until proven otherwise, the long-term trend is still your friend. Looking at Q3 2021 performance was just what we see in the short time frame. It really was a tale of two cities in the quarter. We had strong risk-on performance in that late summer, July, August time period, and then we saw this really risk-off market in September. And really leaves you with a basically flat market for the most part, with a few extreme price movements at either end of the spectrum. And you can see that in the yellow bars, which yellow represents alternative asset classes, which means anything that's not in equity or fixed income land. And you can see that really that inflation trade, those higher inflation numbers were really driving the performance. As you can see from the left hand of the chart, with commodities up over 7, oil up over 5. You actually see TIPS, which is an inflation hedge treasury instrument, up almost 2% in the month. So you can see really inflation driving those long-term good performance in the quarter. When we look at equities, we have US equities in light blue. Anything that's overseas, think Europe emerging, is in green. And you can see from the chart that, large cap tech, represented by NASDAQ here, is up over 1%, really beat all of US equities, including the S&P 500, which was basically flat in the quarter at 50 basis points, and really beat small cap, which was down almost 3% in the quarter. We also saw US beat international, right? International developed, think Europe, Japan, was down about 1%, with EM down almost 7%. And that was really driven by China. I don't know how much you've seen about the headline risk, China government intervention into private companies in terms of gambling and at-home education. And then also they're having a little bit of a crisis with one of their big property developers, Evergrande, that's missing some debt payments. So it's really weighing on Chinese growth a little bit. And you can see that reflected in the price in the quarter, down almost 7%. Silver brought up the rear. Again, it had a massive run up. So sorry about that. Q3 performance. It really had a massive run up. So again, it is a large pullback, but it's after a large high price performance. When we look at credit, we think fixed income bonds, that's represented by purple. Really credit over duration. Duration is represented by treasuries. And on this chart, the belly of the curve, the 2 to 10s, really rose the most in the quarter. And we really saw credit in terms of high yield, which is represented by junk right here, and floating rate really outperformed those duration, which is represented by treasuries. Long-term trades right here only up 3 basis points. We also added thematic growth in this month. That's that thematic growth light blue bar right here. We've added this to the asset class, and this is an ETF by Global X, and really is trying to identify disruptive macro trends in financial markets. So we're going to keep monitoring that, and that had a tough quarter given the pullback we saw in September. So again, overall quarter, not a lot happened other than a few extreme movements on either end due to inflation and a little bit of the China growth scare. Taking a longer step back, taking a look at the same asset classes we just did in a quarter basis on the year-over-year growth. So it's a much different story. You can see here as year-over-year performance is decidedly in the pro-risk camp, right? Really led by oil, up almost 85% over the past year, followed by the equity markets, right? You can see that the S&P, the US small cap, NASDAQ, international EM, all clustered around that higher left hand of the side of the chart, which indicates they had better performance on a year-over-year basis. And those equity markets tend to outperform when we see risk-on environments in the marketplaces. Looking at fixed income, higher rates and a steeper yield curve year-over-year really led to credit outperforming duration. That's that high yield floating rate muni bonds. In fact, long-term treasuries actually was the worst performing asset class over the past year, almost down 11%, which probably shocks a lot of people. People didn't think you could lose that much money in treasuries. So again, where you take risk matters. And, given price performance year over year, you can see investors really gravitated towards credit in terms of high yield, floating rate over treasuries. We did also see a change in the dollar. You see the dollar was pretty much flat there at down 25 basis points, but it really had a strong quarter. And that recent short-term strength in the dollar, it really halted the long-term downtrend we've been seeing that we saw in last quarter's presentation. So it hasn't switched yet to a uptrend, but again, looking at that closely to see which way the dollar is going to break, and that will have a big impact on how we allocate to international markets and US markets in the equity level. Given the risk-on feel in the year-over-year, no surprise, precious metals, gold, silver really brought up the rear performance. So taking a big step back and just the overall picture, long-term return numbers declined on a quarter-over-quarter basis, which means that, last quarter, these numbers were a little bit higher on an absolute basis, but still tough to be depressed about any of the performance we're seeing on a year-over-year basis, and very still favorable levels for investor portfolios. Taking a look and drilling down on factors, we view the U.S. space through a multi-factor lens. And what we're looking at here on the left-hand side is a 3-year history of different factors. Quality is the best performing factor, which you can see there in the blue. We have size, dividend, momentum. And these are relative performance numbers. So this is compared to the entire U.S. market. So it's not up 1%. It beat the entire U.S. market by 1% over this time period. Quality was the best performing long-term factor. But when we look at a more shorter time frame, which is on this right-hand chart, you can see the blue is a quarter to date, and this aqua green is year to date. You can get a little bit different story. So year to date, you can see value up at 3%, was the best performing factor, followed by size on a year to date basis, but it had a very weak quarter, down almost 4%. One thing we try to figure out here at Stonehearth is this a change in trend, or just maybe a pause in the long-term trend here in terms of when we see risk on and growth, you expect value to outperform, which we saw on a year-to-date basis, longer-term numbers, but it's pulling in a little bit here on the short term. Is that just a pause or a change in trend? So one thing we look at is the weight of the evidence, right? And we want to see what the data has to say. So with that, let's turn to real-time economic data from JP Morgan. And, looking at the data, again, this is trying to measure real-time economic activity through big data, because you hear about all the big data that's out there, new data like hotel occupancy, US seated diners, going back to the beginning of the crisis. How's it compare? And you saw the big drop off, in February, and are we back to normal yet? And looking at the data shows that the economic expansion we're experiencing is on track. The trend is in the right direction. We see small dips here and there as reopening is not an event, but really a long-term process. In fact, the earning companies are starting to report earnings. And I was listening to American Express earning call the other day, and they mentioned that on their cardholders are back to 98% pre-pandemic spend. So when we look at overall the entire cardholders, they're almost back to where they were pre-pandemic in terms of spending. So that's a good sign for future economic activity. Progress on the battle against COVID is also a large piece to this improving numbers we're seeing in the real-time data, and should provide support for future growth, as we can see on this chart. And what we're looking at here on the left is cases in Brazil, South Africa. The US is that red line, and orange line, I should say. And you can see this spike up, the Delta variant, but we can look at the improvement we're seeing overall as it's starting to come down. So starting to see declines around the globe in new cases. When we translate that into deaths, we look over to the right-hand chart, we can see that the deaths continue to trend in the right direction, right? And you can see that should see further improvement on that as less and less cases are introduced throughout the population. So again, we also can see that vaccinations are helping. Look in the top right-hand chart. You can see that it's slowed down a little bit, but vaccinations are still being rolled out, and it's kind of helping this. So again, always on the watch for further breakouts. I hear there's a Delta of the Delta variant out there, but as of right now, the trend is in the right direction and does provide support for future economic activity. So talking about economic activity, let's turn to GDP numbers in the US. And what we're looking at here on the left-hand side is a long-term trend growth rate, which is that dotted blue line of GDP, which has basically been 2%. And we can see that darker line is the actual GDP growth. And again, this is a good example of mean reversion in real time here. You can see it's above trend, below trend, above trend. But again, looking where we are right now, we can see we're still below trend. You can see that damage done, that big drop off in GDP right here. Just how far we have to get back to normal run rate of 2.5% growth. And this gap, is why I believe that the economic expansion has room to run, right? So, people always talk about, are we in the first inning, the second inning, the ninth inning? I'm not sure, but I do know, given that mean reversion, given what we've seen through the past, that we still have some economic gap to fill here. And we do have some room to run in terms of economic expansion. And we do expect above average economic growth, because again, if you kind of go back to trend growth, you need above trend growth just to get back to average. So again, it's all continue economic growth, barring a shock to the system, like if there was a resurgence in COVID. But again, not seeing anything like that. And when we look at the call-out number here, you can see the GDP growth is, pretty healthy, quarter over quarter, 6.3 and 6.7. So again, much higher than that 2% and well on the way to getting back to above trend growth. And one thing to keep in mind that'll help you when we look at some future charts here is components of GDP. So what makes up GDP? And I'm not going to go into how we measure GDP. We don't have time for that. But net, thinking about GDP, the big number I want you to keep in mind, almost 70% is consumption. That's consumers. That's you and me. That's people spending money. So let's take a look at how consumers are doing. When you think about consumers, the first thing you want to think about is jobs, right? The labor market. And I know we saw a disappointing print in September. We only created 196,000 jobs, which is way below estimates and predictions. But again, one data point does not make a trend. And as we saw in the previous 2 months, jobs numbers were revised up. So once they reported that 196, in the back of the headlines that they didn't report was that the previous 2 months were revised up by an extra 200,000 jobs. So in total, bringing the last 3 months, we like to smooth it out so we don't get any one data point. We've created over 1.6 million jobs. So that's a good thing, right? And we can see the unemployment rate coming down, which is that red line on the top chart, going down to 4.8. So again, more jobs are being created, less people are unemployed. That's all good and points to future economic activity. And then we look at the bottom clip, we can see wage growth is continuing to grow at a very healthy pace. The aqua green line is the nominal wage growth, and the pink is when you take into account inflation. So obviously inflation takes a bite out of wages, but it's still positive, it's still heading in the right direction. So looking at this, overall, the labor market data is a very positive influence on future economic growth. We're the very healthy labor market. And the next obvious question is, okay, great, that happened in September. What about the future? Why are you confident that this is going to translate to future economic activity? Well, again, as always, we return to the data. And the data says, we have a lot of room to run in the labor market. So what we're looking at here is a labor market from a different perspective, taking it from the perspective of job openings. So on the left-hand side, that's the amount of job openings at any given point in time, going back to 00. We see we're at record highs with job openings. We look at the top right-hand chart, small business jobs report. Is it hard to fill? So that's asking small businesses, can you find employees? Is it easy to fill a job? Again, record high, saying it's extremely hard to find people to fill jobs. Look at the bottom. Look at it from the consumer standpoint. Is it hard or easy to get a job? They're saying it's very easy to get a job, and they're positive that if they needed to get a job within the next week or so, they could very easily get a job. So consumers are extremely confident in the job market. So again, we saw good numbers looking backwards, and when we look forwards, we can see good numbers and a positive influence on the economy. So again, the labor market we think is still very healthy. Nothing is perfect. There's always a little fits and starts here, a little friction, but overall, using the weight of the evidence, very positive for future economic activity. Another positive influence we're seeing in the market on the economy is the housing market. And we can look at that bottom chart. Not going to come to a shock to anybody here. Prices continue to scream higher. So that's using the Schiller U.S. Composite National Price Index. So it's not any one market, it's the U.S. It's up 7% from last quarter when we looked at this, and heading showing no signs of slowing at all. We look at the top chart, rebound in sales, which is that blue line, and green line, the housing starts, a nice uptick. So again, good for the economy. Rise in prices boost consumer confidence due to the wealth effect. People tend to feel wealthy when the house price is rising. And when starts and sales are increasing, they throw off a lot of consumer economic activity. Just think about it. When you start to build a house, all the manual labor that's involved, the materials you have to buy, even if you're just selling a house, furnishings, upgrades, all this increases GDP, right? And remember, I said to remember that chart of GDP, 70% is driven by the consumer. So again, looking from this perspective, the housing market is a positive influence on future economic activity. Another really good sign for future economic activity is leading indicators. And these are pointing to expansion. They're both diffusion indices. So the top one is the manufacturing, so it's an attempt to measuring manufacturing activity in the US. And the bottom one is non-manufacturing. So think services, nursing, healthcare, things like that. I like this because this is not measuring the past or the present. like most economic data we're looking at, but provides really insight to the path of future economic activity. So they're asking people who run companies, are your sales getting better, staying the same, getting worse? Are you ordering more goods, less goods, same goods? And they have about 10 to 15 questions they ask. They put that all together. And when this reading gets above 50, that means the majority of the answers to the questions were getting better. So again, this is really a look ahead indicator, which is why it's called leading indicators. And both, anything above 50 indicates expansion. So again, both are firmly in expansion territory and providing support for continued economic growth. So again, looking at the economy and the data that we think matters to future economic growth, the data is pointing to a strong economy and a very healthy consumer, which should lead to above trend economic growth as we head into 2022, because we know we have some room to run. One entity doing their part to help this is the Fed, right? I'm looking at the Fed's balance sheet, looking at composition of what they bought going back to 2003. You see the massive response to global financial crisis here, but even the more massive response to COVID. Maybe a bazooka and to kill a mosquito, but all in all, they saw a need and they jumped into the marketplace with a bunch of QE. So we see this massive expansion of the Fed's balance sheet by buying fixed income instruments in the open market. And this is really their attempt to keep rates low and provide liquidity for the markets, right? So if you have a bond, you can't spend it, I give you cash for that bond, you can go turn around and invest that in a factory, invest that in a labor force, invest that in the stock market, which is a lot of that's happening, and that's how it provides support for the stock market. I don't think that's their intent, but that's the effect it has of throwing money and all this liquidity in the marketplace. So they've done that and more, and really looking at this balance sheet, the takeaway for me is you can see that the Fed has done a good job in telegraphing their moves, right? So they mentioned they're going to stop buying loans, they're going to stop buying mortgage-backed securities. And this really is to limit any surprises in the market because they have a tendency to spook investors. And we don't think that will change, right? They've been very good at that. So given this backdrop, listening to what the Fed said, their indications, the dot plots, their press conferences, the Fed is on track to slow down purchases. And you can see that in the forecast, right? What the dotted line is, this is what's happened on the left-hand side. Go over here, right? And on the right-hand side is the forecast. And you can see that the forecast is for a flattening, but not a decrease. So even if you start slowing purchases, it's not the same as removing support. There's still going to be a lot of support in the marketplace, just not as much as it was before. So the balance sheet is still expected to grow. That's been flatline. Maybe not as fast, but growth nonetheless. So the Fed is still going to be providing good liquidity with purchases of fixed income instruments. We'll be watching this data very closely for any changes to this thesis or any changes to the Fed's philosophy. But for now, given the extreme level of support, a slight reduction in bond purchases that should start in December of this year really should not harm the economic recovery or hurt equity prices too much. Now, the other thing to remember about the Fed is this is not their only bullet in the gun. They have multiple levers to pull, and they also set short-term interest rates, which is still right around record level lows. And you can see that from this chart here going back to 00. You can see we're right here. This is the actual rate. Everything in the dotted line is predicted by either by FOMC year-end estimates, market expectations, long-run projections. But again, this is where we are right here. And you can see throughout history, we're still at record lows. So again, when we look at this, we see the GDP change that's going higher. We expect these rates to go higher as economic activity increases and the economy gets better. So again, definitely headed higher, but a long way to go given how low we are, and really a long way to go before we really become restrictive. Because even when we look out to 2024, I mean, we're still only up at 1%, and going back in time, that's still very low compared to history. And then there's a mantra on Wall Street, and I tend to believe this, and history shows this, right? It's not the first rate hike that gets you, it's the last, right? So the first rate hike, things still go all right. It's that last rate hike that really starts to hurt equity prices, and we still have a lot of room left to run here. So one of our mantras and our constants here at SCM is don't fight the Fed. And looking from the Fed's point of view, in terms of their balance sheet, in terms of where they have interest rates, it's that Fed policy is highly supportive of risk assets, and we don't want to get in front of that. So a very positive influence on the market. So we've gotten through all the positive. Now we have to look for some negatives. And with all these positives, it's time to look at some negatives. And we'll start with the federal government's financial position, which, as we all know, isn't exactly great and just seems to be getting worse and worse. So what we're looking at here is the federal budget balance sheet of the federal government on the left-hand side. So without any more stimulus, and this is just actual spending, this is not anything that could come down the pike like the 1.9 trillion, Build Back Better. Right now, given where we stand, we have to borrow almost 21% of our spending needs. That's almost $1.2 trillion. So that's just outstanding. It's amazing, and there's no end in sight. So these numbers are put together by the CBO, which is probably as nonpartisan as you can get. They make no predictions about the future. They just say whatever's happening now keeps going on into the future. They don't have any dog in this fight. They're not trying to dictate policy. They're just saying the numbers are what they are. And there are no end in sight. Look at that bottom right-hand chart. The deficit just keeps growing and growing, and it's the net debt. And then we can see the budget deficit coming down, but still at very highly elevated levels at the top right-hand chart. In fact, look at that net debt number at the bottom right-hand chart. It's the highest it's ever been since World War II. This really is a good reason to hold hard assets, think precious metals, as something has to give here. And a little protection in your portfolio, not a bad idea. Another negative, or another risk, I should say, because, there is some opportunities with inflation, it's inflation. The Fed finally came around to the idea that inflation was actually evident and here recently. They're still holding on to that, fallacy that is transitory and it's an illusion and it's going to go away soon. And we really have tough time seeing that. So looking at the numbers here on the top chart, we're looking at the CPI and the core CPI. The core CPI just backs out food and energy because in the Fed's infinite wisdom, they don't think anybody spends money on food and energy and it's too volatile to track. Doesn't make a lot of sense to me, but for whatever reason, they've done that. That's that red line. The blue line includes food and energy. Either way, it's elevated and it's up. And the more important thing to me looking at this chart is that green line. That's the producer prices. So what are producer prices? That's the beginning of the production cycle. Think back to economic activity, right? And we always use widgets when we talk about economics. Everybody thought when it went to college, you always had widget factory. Think about that widget, right? You have to go buy some metal. So that's a producer price. You have to go buy metal. You got to buy some plastic because the widget needs to be put into plastic, that metal blade. You buy some plastic. That's in the beginning of the production cycle. Those costs are up almost over 8%. So those are rising a lot faster and a lot higher than the end prices, what you're paying for something, right? Unsustainable. So again, we do think this is one reason why we haven't seen the worst of inflation yet and does have some room to run. PPI tends to be more structural than temporary when you do think about prices being paid. So looking at the producer price indice, looking at the level of inflation, looking at the tight labor market we saw, looking at the Fed balance sheet, looking at some of the stimulus and spending coming through the government, really challenging to find any case that inflation is transitory. So we think it's not permanent because nothing is permanent except death and taxes, but we'll be here a lot longer and we'll run a little bit hotter than most of the market is expecting. So inflation hedges are definitely warranted in terms of portfolio construction. So turning to valuations, again, a big negative on this market. It's been overvalued for a while. Valuations have never been a good timing indicator, but have always been good to judge the amount of risk in the marketplace. So, but as we always say here, where you take risk matters, and there are pockets of opportunity. So what we're looking at here on this chart is global valuations. On the left-hand side, it's its valuation relative to history. So is it cheap compared to where it's been historically itself? On the right-hand side, we're looking at it compared to the S&P 500. Like most charts, green is good, red is bad. So very easily you can kind of pick out the good parts, and you can see that small caps are looking very attractive. That's an S&P small cap 600 index. The PE compared to history is in the 23rd percentile, and compared to S&P 500, it's never been cheaper than it has right now. So again, even if in aggregate we're seeing extreme valuations, we're still seeing some pockets where you can provide some good valuation support. EM, again, on the bottom here there, continues to look attractive from a relative valuation standpoint, maybe not as attractive from an absolute standpoint. Brazil stands out, green across the board. But again, sometimes asset classes are cheap for a reason. Brazil's having riots in the streets. They don't like their president. They're having some problems. With COVID and how we handled it, and Bolsonaro is probably going to be shown the door. So sometimes assets are cheap for a reason. The risk have risen there. China also looks a little bit cheap there, but again, we talked about the Evergrande and the fallout from the Chinese government intervention. And we do think that even with the valuation support in China, that the risks have risen there. So again, it's just not one factor you're looking at. You have to look at multiple factors. So looking at the risk in China, that they are definitely cheap, but also they're cheap for a reason because the risks are rising in there. So again, overall, there is still some pockets, and you can see that from like S&P small cap index looks very attractive on a relative basis for valuation. From an equity standpoint, one thing supporting this market is earnings, right? And they've been very strong. Earnings growth and revisions continue to be a positive influence on this marketplace. So what we're looking at here on the left-hand side is growth estimates. And you notice right away, I'm not looking at absolute numbers. The S&P is supposed to earn 220, 210, 205. Doesn't really matter to markets. To me, what matters to markets is, are they beating expectations? Are they growing faster than expected or slower than expected? Are analysts raising estimates? So that left-hand side, that's our growth estimates, right? So we can see that growth is picking up and it's higher than it was. And more importantly to me, you look on the right-hand side, these are EPS revision numbers for the EFAR, which is international equities, S&P 600, the red, which is small cap, blue S&P 500, and gold is the emerging markets. Those are the analysts increasing their earnings expectations or decreasing. So more analysts thinking earnings are going to be higher or lower. And again, anything above 1 indicates that more analysts are raising estimates and it's a positive influence. And you can see that it's above 1 for all the markets. So this ongoing profit and earnings recovery does provide strong support for this bull market we're experiencing. And earnings season's just started here. About 20% of the companies have reported. And when we kind of look around that, you can see that 65% of those 20% beat by 1 standard deviation or more on earnings. And even more importantly to me, sales, right? Sales are less manipulative. You can manipulate earnings, buy back some shares and do some things and pull some levers. Sales are sales, they're revenue. And sales are coming in 50% greater by 1 standard deviation than history has shown at 35%. So 50% of the companies reported so far have beat sales by 1 standard deviation. We look throughout history, that average has been 35. So again, very strong from global corporate earnings standpoint and providing support to this market here. So before we leave the equity market and head to fixed income, there are a few issues going on I'd like to talk about in the equity land. First one is tax hikes. So there's a lot of noise coming out of Washington. Tax hikes are off the table now, at least in this bill, last thing I saw. But again, I don't think this is going away, right? You can just see the conversation becoming more and more pronounced and maybe more worse. But again, we can just see tax hikes being more ingrained into the metaverse out here. So when we look at history, and again, take it with a grain of salt, we're only looking at 3 data points, 1987, 1988, and 2013. But the impact looks like more noise than signal, right? So it may get a lot of press, you may hear a lot about it, but the net effect to the overall equity market is not that big. So on what we're looking at here is a light blue, a 6 months performance before the rate hike. Dark blue is 6 months after. So we look at the S&P 500 return for the first. So again, you can see when people hear about a tax hike, they sell, not a lot, but that's more than compensated for the amount of return afterwards. Then we look at the PE change. People pay more for the same stocks after the rate hike. Well, it makes sense because rate hikes do dilute earnings, and if performance has gone up, earnings are down, you pay more for that same security, but that's more positive for the market. They're willing to pay more. Household equity allocations, really unchanged. So people don't allocate around tax hikes in history. The one effect we do see is this momentum, right? So momentum factor, long, short, you can think about it this way. You go long the stocks that perform the best and short the stocks that have performed worst. So you have an overweight position to stocks that have risen the fastest in the short term. Makes sense. If tax rates are going, I might as well sell now and at the lower tax rate. So you can see where that has a little bit bigger impact than the other one. But if you look at the S&P 500 in itself, very little impact overall due to tax hikes. So again, interesting conversation to talk about. Compared to history, take it with a grain of salt, only 3 data points, but not a big impact overall to equity markets. Something that has a much bigger impact in equity markets to me is concentration risk. And what we're looking at here is the S&P 500, the top 5 companies by market cap, going back to 1990. That's that dark blue line. And you can see back in 2000, dot-com bubble, the top 5 companies made about 18%. We're currently at 23%. The companies we are that make up that, everybody knows, right? It's the Apple, Microsoft, Amazon, Meta, the company formerly known as Facebook, as they're changing their name, and Google, both share classes A and C, or the FAMAG stocks. So again, they make up 23% of the index. It's almost never been higher. We've only been higher just recently in the beginning of 2021. So again, this creates some dislocations in the marketplace in terms of they overwhelm the indice by just being so large. So if they do well, those 5 stocks, the indice does well. If they do poorly, indice does poorly. If they're overvalued, the S&P 500 appears more overvalued because they have a higher impact. So again, there is some concentration risk by just owning the S&P 500, which people think, oh, this is broad-based index. Well, your top 5 positions are pretty much all in tech, and they can kind of fool around with where they are, but they are pretty much all tech companies, and it's 23% of that indice. So again, people have got to be aware of how the indices are made up, which is one reason why we like factors, right? That spreads that risk, goes down in cap, looks at the smaller cap, and finds those stocks that are more correctly valued than those what we feel the overvalued, top FAMAGA stocks there. And again, there's one last thing before we leave here. You can see that earnings. So again, that's why we're saying they're hitting above their weight. They're only 16% of the earnings of the S&P 500, but the market cap is 23%. And sometimes the performance is like 30, 40, 50% of the performance is just in these 5 stocks. So is the S&P 500 really telling what's going on with all the companies, or is it reflecting a few of the much larger companies in the marketplace? I think the latter more than the former. So something to keep in mind when you're looking at the S&P 500 and investing. So that's the equity land. Now we're going to turn to fixed income, which didn't really move a lot in the quarter. Not a lot happened here, which is surprising because we think this is where all the action's going to be into 2022 as rates rise and inflation comes in harder than expected and the Fed has to act. But at least for this time, this quarter, little or no movement in the long and short end of the curve. A little few kinks in the middle end of the curve. In the middle end of the curve, if we think about that, is this 5, 7, 10, and we can see that like what moved on a quarter to date basis, which is this aqua green. You can see up 5 basis points, up 8, 2, a little bit down on the 30-year, and no movement on the short end. Again, it's just more at the technicals of the marketplace that we don't need to go into. That doesn't really not indicating any signal, just more noise. So overall, big takeaway, not a lot to see here. Steepness of the curve was unchanged in the quarter. And when we look at the curve, it's still steep, right? Still pointing to future growth, the positive spread on the 30 to 2s and the 10 to 2s. So historically, long rates have fall, and the curve flattens when investors become concerned with slowing growth. We're not seeing that. The curve didn't flatten in the quarter, and it's staying highly positive spread. So again, still all clear from the yield curve. Turning to interest rates in the longer term, it didn't move in the quarter, but we do think the trajectory of rates will be higher. It may not be tomorrow, won't be in a straight line, but the trajectory of rates will be higher. And we're looking at here is the nominal 10-year Treasury yield going back to 1958. You can see where we're at, like 1.52. We're at record lows almost. We just coming off the record lows we saw just recently. So again, we're in very low compared to history here on a nominal interest rate. So I do believe this rates will be higher and will have an impact on the bond market and where investors want to allocate their risk budgets in fixed income. And you can see that on the right-hand side with the effects of what happens to individual asset classes and bonds when rates rise by 1%. So again, you can see the impact of a small 1% rate rise compared into treasuries. You can also start seeing where you can find some positive, like floating rate we like a lot. You can see that it's a little bit different when rates rise. And again, we do think it headed higher just given the low level of rates, the high inflation, increased economic activity. And the other thing to look at is that brown line. That's the real 10-year yield. So what is that? That's just that nominal yield minus out inflation. So the bonds, government will pay you 1.5% pretty much for 10 years. If inflation is running at a little under 4%, which it is right now, your net return is negative 2.5%. So you're losing money in purchasing power by holding a 10-year bond to maturity. We don't think that's sustainable. So another reason why we think rates have to move. But for now, I think we can see equities and bond yields rise together, although we will see a tipping point at some point, really watching those real yields when they get out of hand, where they will pose a problem for equity markets. And again, like we mentioned before, it's the last rate hike that gets you, not the first. So one really more piece of fixed income before we look at our risk model is we're looking at spreads on corporates. So all this is looking at how much extra income investors are required if they're going to lend money to riskier parts of the market, right? So we all heard about the risk-free rate, which is the US government, which I may want to argue that they're not risk-free, but for now, in economics, they are the risk-free rate. So that's the rate that you would lend to the government. Now, if I wanted to lend to a corporation, how much more interest would I require given the riskiness? So again, you can see the higher these spreads, the more risky we think lending money is, and the more unsure we are of future economic growth. The lower these spreads, the more confident we're going to get paid back, the less interest we require from companies, and the more confident we are in the future economic future. So with that backdrop, you can look, we're almost at record lows across the board. We're looking at corporations, investment grades, think Apple at the top, looking at high yields, think more some of the energy complexes, some of the more tech companies, mortgage-backed securities, that's when they're lending money to groups of mortgages and agencies. So again, looking from here, we're looking for any potential dislocations because they tend to show up here first. And we're not seeing any signs of this widening, but that's something we're watching for. So something to pay attention to is if you start seeing spreads widen, then we can start getting more concerned about the economy. We're just not seeing that now. The other side of that argument is also that since they're so low, there's not a lot of income to be had here, right? It's still a little bit low. So, and there's not a lot of price appreciation that can happen here on the fixed income side. So really when we're looking at the fixed income land, we're looking at balancing the portfolio. So we can kind of give you that return when equities turn negative sometimes, and also just clip the coupon and be very happy here. So we do like floating rate and some high yield here. So turning to our risk model, and again, it's a multiple risk model. We look at technical, valuation, macroeconomic, and qualitative data to observe how much risk is in the marketplace. And that's an important point that I would like to get across. You know, when we talk to investors, we talk to our clients, and we look at this model, a lot of people think we're predicting something. This isn't predicting anything. This is observing the level of risk in the marketplace. And is it conducive to future economic activity and in turn, future price appreciation in the marketplace? That's all we're doing, trying to observe the level of risk. So with that, let's see how much risk we're looking at in the marketplace. We're going back in time. The charts are going back to 2020, so the past 4 indicators. And the last right-hand chart is as of 9/30/2021. So we can see right around the technical fell by 1 and switched from a positive indicator to neutral in the quarter. We saw reversion actually turned positive, right? So it was actually up by 1. It was -1 last quarter. It's neutral now. And really that was driven by the price weakness we saw. It really had an improvement on the RSI. And the RSI really attempts to indicate when a market is overbought, too many people have bought too fast, or oversold, you sold too fast, and looking for changes to long-term entry exit levels. So again, a little bit more positive on that given the weakness we saw in September. The real weakness and the real signal from the technical indicator, I think, was in the structure. And we saw that come down from a +2 last quarter to a 0. So when we're looking at structure, we're really looking at sentiment, trying to measure investor sentiment. Are investors willing to take a risk? Because we know markets are strongest when broad and weakest when narrow. And when investors are willing to take on risk, they tend to be strong. And we did see a weakness from 2 down to 0. You know, it really declined on the lack of breadth. So we saw less companies being above the 200-day moving average and making new highs. And we saw that small cap weakness, which again is indicate that investor sentiment declined a little bit. The one good takeaway, another big takeaway from this is it didn't go negative, which is what we're watching here, right? Even though it decreased a little bit, it didn't switch to a negative sign. It's still neutral. So again, is it was positive as it was last quarter? No, for sure. It's definitely lower, but it's not pointing to a negative sign on the technical picture. So we're neutral from a technical standpoint in the marketplace right now. Valuation continues to be negative, right? Unchanged. Those strong earnings we saw, you know, not enough to offset the high valuations we're seeing in equities. So valuation is still a negative influence on the risk environment. Into the macro data, and this is data that, you know, leading economic indicators points to future direction of the economy. Like we saw those PMIs indices, those diffusion indices, those are in some of our macroeconomic data we use. You know, did have a slight drop, went from +4, which is this max score, to 3. And that was really driven by a fall in copper prices in September. And that really had to do more with China-specific issues than a larger read on the overall economic activity. So what we call noise rather than signal in that. And it is only one data point, And if you look at the weight of the evidence, the economic factor, it's still a +3, and it points to economic expansion. And it points that this will continue to march on as a very positive influence on the amount of risk in the marketplace right now. And the last one is qualitative. And again, this is just 20 years of investment experience on Stonehearth's investment committee, made up by the 3 advisors and myself here. And we talk about, we've been in this marketplace, we've seen things. And what we're looking at in the qualitative aspect right now is anything that's not captured by a model. And what we're looking at that is the monetary support and level of debt, right? So that positive influence we're getting from the monetary support, from the Fed's balance sheet, from low interest rates, is being offset from the negative we're seeing from the level of government debt. And really equates to a neutral reading when we use a weight of the evidence approach. So putting this all together, using that weight of the evidence like we always do, the risk environment remains positive, really driven by positive economic data, a neutral reading on technical data, and a negative valuation picture. But overall, risk is still a positive influence in financial markets. We want to be leaning into risk here. We don't want to be increasing risk, but we want to be leaning into risk from where we are. So how does this translate into portfolios? So when we're looking at our portfolio, this is our current asset allocation as of September 30th with our typical moderate client. Individual clients could be different, and individual different risk levels could be a little bit different. But overall, no changes to our overall positioning in the quarter. Given that positive risk environment we saw, that strong economic data, we're overweight equities. But like we started off this presentation, where you take risk matters. We're underweight US. Really, that's driven by those top 5 stocks we talked about, the FAMAGA stocks, the 20% industry concentration. So we really like small cap better, find some good value in value stocks. So we have exposure to them. But overall, at the big high level, we're underweight US. Neutral international developed, still like exposure to that, still have a healthy exposure to overseas markets. We're just not tilting above or below what our desired long-term exposure is. Emerging markets were overweight. We did see the data from China come out. We do think that has an influence on emerging markets. We do think that's increasing risk there, but that's being offset a little bit by that great valuation support we're seeing there. So for now, again, we're overweight emerging markets, where you take risk matters. Looking at fixed income, and this is the classic where you take risk matters, is we had neutral fixed income, but we would not recommend anybody going to long-term treasuries yet, given where we see the rates environments. We do like credit over duration in different parts of the fixed income marketplace, like floating rate. We also like inflation hedges, and we're not too particularly entwined with tip securities, because again, they have a duration perspective. So we have an inflation product in our arsenal that doesn't rely on fixed income instruments, but relies more on which way inflation is going to go. So again, having those inflation hedges, having fixed income instruments that can work with higher rates is really mandatory in this environment, and really going with those managers that can manage that duration profile. Cash, not earning a lot. I wouldn't go overweight this, wouldn't have a big piece of it. It's not really a lot there. And our opportunistic bucket, again, this is something we've added recently, and what we're really looking for is those opportunities in the marketplace that really provide some a little bit excess return for clients. Right now, we have allocations to precious metals. Again, we saw the federal government net debt. We saw the deficit that they run, that they have to borrow, and just the amount of debt out there. I think it's good to have some precious metals in your portfolio. We also have a good allocation to clean energy, which I've talked about in previous presentations, and I'm happy. Anybody wants to call the office and talk about it, we can talk about this for hours. But it's a great opportunity in the marketplace. And disregard the bill that's happening, right? That is just icing on the cake. That is just not impacting this on the long term. This is just a long-term opportunity as we transition from a carbon economy to a more carbon neutral economy. So again, having some good exposure there. So overall, that's where the portfolio stands. We'll get to some final thoughts here. So what have we learned today? Well, we're in a positive long-term trend. Support balance against a little short-term weakness, but for now, the trend is still your friend. COVID, we're seeing improvement in the data as the impact from the Delta variant recedes. So that's having a positive influence as of September. We saw the economic expansion, seeing it set to continue as the weight of the economic evidence we're looking at points to above trend growth here. Saw the massive liquidity being injected in the markets. Do not fight the Fed. And saw the inflation numbers definitely here to stay for a while. Not a bad thing all in all, but must be accounted for in portfolios. Still elevated valuations, but pockets of opportunity if you know where to look. Seeing strong earnings numbers, strong fundamental support for further price increases in the marketplace. So earnings are very strong, leg of the stool. in terms of future economic growth and future price appreciation in the market. While the lows may not have been set yet, and it may not be a straight line, the trajectory of interest rates will be higher from here. And as always, where you take risk will be more important than the level of risk you take. So kind of summing it up, positive environment for taking risk, and our traffic light remains in the green zone. So with that, I'll turn it over to Amanda to see if we have any questions out there.
Hi, Chris. Can you hear me?
Yes, I can, Amanda.
Okay, perfect. Yeah. So thank you so much for all that. I do have a couple questions, but just as a reminder to everybody, there's a question section under GoToWebinar taskbar here. So feel free to submit those questions and happy to get those answered if we have the time. The first one, Chris, I have, it says, if you think rates are headed higher, why are you overweight in equities? Shouldn't we be selling US equities?
Excellent question. And we get that a lot. And actually, we did just had our IC meeting recently, and that was a big hot topic of the conversation. To me, it really gets to the data. And let me check it. I can pull this up here. Hold on 1 second here. Because I do have something on here, so let's do this. So bear with me for 1 second. I think this will help explain kind of where we are with rates. All right, I'm just pulling it up now. All right. Hopefully you can all see this. Again, this is something we presented at our IC meeting recently. We've talked a lot about. Probably should include in the presentation because it really is a good question, because it gets to this question, why are equities rising when we see interest rates rising as well? Because shouldn't that be the opposite? And we look at history, and we're looking at data from Goldman Sachs here at US equity rate rise. And this is why we say it's not the first rate, it's the last rate that gets you, and it's also how the Fed telegraphs. So we're looking at interest rates going back to time since 1965. On the left-hand side is when rates are falling. On the right-hand side, rates are rising. And what it's indicating is a z-score, right? So what a z-score is just a differential from the average. So a high z-score means it's a lot farther from the average in history. And what we're looking at here, and we see these returns, and what we're looking at is a 1 month return, that when rates rise in a rising rate environment by 5 basis points, not a lot happens, right? Equities still do well. Even when it goes up by 1, equities still do well. So again, if rates are expected to rise and they're going up, and in the beginning of the rate rising cycle, equities do all right. Now, when we get to the 1 or 2, you can start seeing some weakness in returns. And the real negative returns come when it's greater than 2. So again, looking at historically from the data, it's not that first rate, it's not that rates are going up, is that rates go up unexpectedly or at a big higher amount than expected, right? So what could do this is higher inflation, right? And the Fed has to raise rates higher than they think. But again, a slow measured rate rise, and you can see where equities still do well in a rising rate environment. And then when we look at the composition of the equity market, we're looking at here from RenMap is, I'm not going to look at this too much longer, but again, it's all these different industries. And the left-hand side is negative returns, negative sensitivity to 10-year yield. So when yields are rising, these have negative returns. On the right-hand side, positive returns. So where you take risk matters. Yes, overall, there are a lot of pieces of the equity markets, and we look at software, water utilities that may not do well in a rising rate environment. And on the right-hand side, we would look at some banks, capital markets, machinery, oil, energy, thrifts and mortgage. They tend to do well when rates rise. So again, don't just believe the story, look at the data. And the history of the data says the equity market can do well in a rising rate environment, as long as it's telegraphed well and doesn't get too out of hand and the rates don't rise too fast. And even if they do, there are parts of the market that are positively exposed to those rates rise where investors can take some opportunity. So I hope that explains why we're still overweight equities and why we remain overweight equities, and we still think it can work.
Thanks, Chris. The next one I have here is, are you concerned with the events in Washington? And how might that impact our portfolios?
Yes, yes, and yes. I'm very concerned, as we all should be, right? They govern us. They're the government. They run the country. They have a big influence on society, and we should all be concerned about what's going on constantly within Washington. In terms of portfolio, it's a little bit tough. So the first thing, again, as an investor, I need to invest in the world as it is, not how it should be. So again, I come in with my biases. I have my own political leanings, whichever way they are, but I can't let that influence my investment decisions because I don't want to invest on my philosophy. I want to invest in what's happening and what's most likely to happen. So when we look at Washington, we tend to look in terms of things that they're likely to impact: tax hikes, change to legislation. And we're always bringing that into the portfolio, but we don't let it impact it too much because we want to look at all things. So Washington is just one piece of that larger puzzle. So we take what they're saying, combined with the economic data and the technical data, and then we take in the fundamental valuations, and we combine that to use a weight of the evidence approach. So we're always watching it. It does have an impact, but it's not like a direct impact when they say we're going to raise taxes, we're going to go do something. We'll input that into our decision-making process, weigh that against the other factors in terms of price action, what the economic data is telling us, the valuation standpoint, to make an overall weight of the evidence decision. So overall, as citizens, we should all be concerned with what's going on with Washington. I think, to me, no matter which side you're on, just the level of discourse is not helping anybody, and we need to work to get along and realize that we're all in this together, and that it does influence portfolios, but it's just part of a bigger piece and not directly impacting our investment decisions.
Thanks, Chris. Just being mindful of time here, I think I'm just gonna stick with one more, and
Okay.
Chris and myself will happen to reach out to the rest of these here after the course of the webinar being over. Given the cheapness of emerging market equities, are you thinking of adding to our exposure?
Well, for one, we cannot comment on anything we may or may not be doing in portfolios. We can always report on what we've done and where we stand. So again, this is not predicting anything or anything trade. I can just kind of give you what we're observing in the emerging markets right now. And like we saw from the data, it is a very strong valuation standpoint, right? And it has one of the best risk returns, at least it did beforehand, given the valuation picture and the expected returns over the next 10 years. We do think Evergrande does change that ratio a little bit, and we're kind of doing that evaluation now where Evergrande, it makes up about 80, well, property development makes up about 80% of Chinese economy and impact, and Evergrande is a big piece of that. So if that starts to slowing the growth, we're starting to see some of the analysts come out slowing the economic growth in China and across EM land. So if that starts to really impact more and more, the economic growth starts slowing down, I think that definitely changes how you look at EM as an asset class, and it may be looking less attractive if that growth continues and the government continues to intervene. So again, I don't comment if we're adding, subtracting, whatever. Just realize that given the EM world, very good, strong valuation support, maybe slowing growth, and we're looking at it constantly on a constant basis. And as things change, we'll get out to our clients if anything changes on that standpoint right now. That's kind of how we're looking at EM. Risks are increasing in that space.
Chris, I just want to thank you again so much for all of this information. Also want to thank everybody who's on the webinar today for joining us. We do have these webinars quarterly with Chris, so our next one will be January, which is kind of crazy. So we'd love for you to join us. If you want to reference this webinar, again, you can find it on our website. I should have it uploaded by the end of today. That's stonehearthcapital.com. Also, once we get next year's webinar schedule up, you can also sign up for our CIO's Corner updates on our website as well. So Chris, again, thank you so much, and I hope everyone has a great day.
Everyone have a great day. Thank you.